Yep. Hi, good afternoon. My name is Vijay Raj, and Happy New Year. This is 2025. Hope the stock markets are, we all have the news of the stock market and the US president news and all good waves or bad waves, but things are 2025 is technically looking very, very good. This is our presentation with regards to what we should be looking around on the investment market. I got my colleague Max with me.
Hello,
Uh,
Vijay.
Yep, Max. Max will give a little more idea. I mean, he's an expert on his area, so we will talk. Some of the discussions will be around our own portfolios, which are cash, conservative, Australian shares, India fund, and income maximizer, as well as we'll talking about a couple of ETFs and couple of overall themes that can be possible. So overall, Max and Max, to you, Max, what do you think about Australian shares and global, and what is the economic environment?
Hi, Vijay, and hi to everyone listening. Look, it's been exciting times, Vijay. Over the past 12 months, a lot has been happening in the markets. Some markets have made a lot of money. By markets, we're talking generally about share markets, and some markets haven't done well. So, this is our one of the first, well, it is the first weekly meetings. So I thought, we'll go, as you've just asked about, take a overall view of how the markets have done, and then in the weeks ahead, we'll step into very specific areas of what's happening around Trump's new policies around, tariffs and geopolitics and how that comes back to our portfolios. So if you would like to indulge me, Vijay, I can start off with just reviewing the Australian share market, if you like.
So one question before we go, like technically Donald Trump makes the news every day. Something comes in. I think technically the market, when the thrilling news comes in, market goes up or market should go down technically.
I think for Trump's all of his, purported whimsical ways, like, people sort of make him out like as if he's saying stuff that's spur of the moment, but he's not really. I mean, he's been talking about these tariffs for actually 10 years, even longer. If you look back, if you read his biographies, he's been talking about it for 30 years. Just balancing the trade. I mean, we can talk about it at length later on, but the bottom line about his tariffs issue with China or Europe or any other country that runs a trade deficit with the US or trade surplus. He wants $1 of imports into the US should be matched with $1 of exports. That is not the case at the moment. In fact, the US is importing almost $1 trillion worth of extra imports and is having to borrow to pay for those imports. And he's, as a businessman, he's looking at it, he's going, this is not sustainable, guys, and the world has to buy more from us. And, that's at the heart of it. And he's been talking about it for a long time. So he's doing something about it this time around. And there's ways to make money out of Trump's policies. And we'll get into that in the weeks ahead.
Thanks. Good to know.
Yep. And so, Vijay, did you want to talk about the Australian share market to begin with? And just because this is obviously our home market, then we'll look at the returns. I've got the slide 3 to refer to, and it's the Australian share market. Obviously, if you can see on the screen on the left hand, you can see the Australian share market chart is trading at record.
Can we get this chart a little bit more onto that, please, so at least people can see?
Yeah. And so the chart is showing ASX 200, and it's trading at a record level at the moment. The ASX 200, 8,400. It hasn't traded at this level ever. And you've obviously heard in the last few weeks there was a sell-off in the markets from the AI competitor coming out of China, DeepSeek, and there was a bit of a sell-off in the market. There was also volatility around Trump seeking to enact tariffs against Canada, Mexico, and China. That also had a bit of a sell-off in the market. But despite all these volatility in the last few weeks, you can see on the right-hand side of the same chart, the performance of the market continues to just move forward. The ASX 200 12 months
Chart,
rolling,
please. Yep.
it's this is a price return, so 10.5% near on. Add another 3-4% of dividend yield. So the Australian stock market is delivering, 13-14%, depending on which week it is you're looking at, and it's been positive for January and February so far, and week and day. So, and so the question is, Vijay, does it look expensive? That's the question, when parts of the market are looking expensive and parts of the market are looking, inexpensive. So, and that's part of portfolio management. We take profits along the way and we hold up cash levels. And anyway, I'll show you some slides on that later on. But the next slide I wanted to share with you, just step into, sorry, Vijay, did you want to say something?
Yep, no, listen, that's a slide. If you, I mean, these people will expand it, so I think you will give those. Yep.
And so the stepping into the where the performance has come from in terms of the sectors, I've got the second chart here. The by sector breakdowns, you can see over the January and February months on the left-hand side, discretionary financials. I mean, it's been right across a whole range of sectors that have been positive. What hasn't done well has been the Woolworths and Coles. Well, Coles actually done well, but the staples, consumer staples as a sector hasn't done well, or has been flat, and the energy and utilities have struggled. But materials, parts of material sector, Vijay, has also struggled because you've got the traditional materials like iron ore, coking coal that go into China, into making steel, which China then uses to develop property and infrastructure, which has been slowing down very decisively, and we'll talk about that in more detail later on in other calls. So that has reduced the prices of the likes of BHP, who are very focused on those kind of materials. But then gold has done really well. So parts of the material sector has done really well into the gold. Banks have done really well. But you know what? Banks have run, Vijay, have double-digit return, 20, 25, 30, 40% return in the last 12 months. But can I just say the only bank that actually meets long-term capital requirement that investors require from these banks is CBA. So CBA is the only bank that's returning. If you look at the 10-year return, that's how long people generally tend to invest for. It's generating 8.5% return, total return, 15 years, about 10%. Other banks like NAB, Westpac, and ANZ are actually returning around 6.5%. So you sort of question, is that adequate return, from these big institutions where traditionally equities should return you 8 to 12% return. So the only two banks that are making that capital requirement, that return requirement, is CBA and Macquarie, which is a different beast. So that's what's gone on there. In terms of the discretionary stocks, again, it's been the sector has been buoyed because Wesfarmers, which is a very strong business, it's like a conglomerate. It owns Kmart and other places, and most people obviously go and do their buying in this era of cost of living in Kmart, and you just got to walk into Kmart and see how busy they are. So as a result, Wesfarmers is doing very well. It's been it's up like 25%, and various other consumer discretionary stocks like JB Hi-Fi, very specific offering. They do their operate their retail outlets very well. But then there are others who have struggled. So that's where the kind of the returns have come from, Vijay, in the Australian share market. And the next question is obviously valuation, and should we be taking profits?
With regards to when the chart PPT number 7, please. I mean, Max was talking about. So I think the valuation and those things are very good. Now, with regards to Max, what do you see that with the allocation in cash should be more, or with regards to some overall, what's your proposal, or should be into more into global? What do you see on the global side as well?
Fair enough. As you know, obviously, one of our six strategies or portfolios that we offer investors is obviously the Australian core share portfolio, it's generating. Our focus is notionally, as I said, equities should generate 8 to 12% return over the 5 to 10 year period. And so we don't push the portfolio too hard to make it too volatile. We take the gifts that the market is giving us, as it has for the past 12 months, and we'll share the returns on the core portfolio. But and it is, generating within that range. But if you look at the chart on Australian shares at the moment on the whole, traditionally, one way to assess the share market is to look at, because Australian share market is very dividend yield returns focused, Vijay. So traditionally, it's returned around 4.5% dividend return, and you get most investors are retirees, so they add franking benefits, and it gets up to 6%. And so if you're trying to get a 10% return out of 8 to 10% return out of your stock portfolio, your dividends, if the dividends do good heavy lifting, weight lifting, to make up that 8% or 9% return, then growth, you don't have to rely on growth too much, because growth is risky. Sometimes the economy is growing and sometimes it's not growing as much. I mean, coming out of COVID, the economy really grew, and growth was really high. But now the economy is growing, Vijay, at 1.8%. That's a low growth environment. If you look at the overall Australian shares, they're returning a dividend yield of about dividend return of 3.8% or 3.79. So that means the rest of it, 7% or 6.5%, has got to come from growth. So how are companies going to get growth of that level when the system itself, the economy itself, is growing at less than 2%? So then you've got to sort of go, that means it's going to be a difficult task, which means whichever stocks that have really rip-roared take profit. So the question you asked is, does that mean we're holding a bit more cash? Yes, we are. If you can see, our portfolio has done, over the past 1 year, 12.3%. That's a bit above our range of 8 to 12% kind of figure that I have in mind. And you can see our top 5 positions. Combank is the highest performing bank in the market in terms of retail banks, and it is our major position, which worked for us. And we're looking to take profits in that. WiseTech, as you can see, WiseTech is zero. I mean, these two stocks. So we were in position ideally in terms of our top holding in two sectors that performed the best. The banking sector and the technology sector. And so that's where our weighting was, and that's where our returns have come from. But that being said, we have been taking profits. We're sitting at around 10%, and that might look a little bit more in the coming weeks. So that's where that is our position in terms of portfolio balancing. Now, I just wanted to share this chart with you as a last point on that. We are being a bit more contrarian from another, because if you compare us to other market managers at the moment. There's a chart that I wanted to share with you. It focuses on large and medium-sized superannuation funds in Australia and their cash levels. Looks like a busy chart, but just pay attention to the green.
Chart number 8. Yep.
Yeah, just pay attention to the green line. Sorry, yeah, chart number 8. And that is the cash level of average super fund that invests in the Australian shares and international shares. You can see, Vijay, that these guys have been running down their cash levels certainly since 2022. The green line has been was at that time was about 10%, which is where we are at the moment, and they've run it down to probably around 3%, 2%, 2.5%. And what that means is they've been piling into the market as stocks have been running hard. And you might say, well, Max, why are you holding, or why are we holding 10% when these, supposedly big guys are piling into the market? Well, that doesn't mean that they're clever, because you can see that just before COVID 2020, 2019, they were also on a long spell of buying into the market. And then when there was a sell-off, they also sold and they built up their cash levels. A contrarian investor is actually selling and building their cash position into rising market. So what will happen is, Vijay, that what I'm basically saying is, if there is a correction in the market, which could easily be, you've seen a couple of episodes of it in recent times, 10 to 15% is quite justifiable in the market right now. So what that means is, these investors who've got the big piles of money already invested in the market, they're going to be pulling money out, which will give us the opportunity to actually put our cash to work and not compete to take up just good stocks on good
Yeah.
valuation.
That was very good. I really appreciate, I think, your viewpoint with regards to cash and how APRA is holding up the APRA's viewpoint and those kinds of things. Really appreciate. Now, Max, I just with this, what is happening in the whole, two important things is the global stock market, which majority we talk from that perspective, and simultaneously India and China as well. That what is those repercussions onto these emerging economies and how the things will play out? I mean, if you can, from the market perspective, would be a good help. Or what's the story?
Thanks, Vijay. So, parts of our strategies, obviously, we manage funds in global markets. So, a number of our strategies are focused. There's obviously India-focused strategy as well. But just looking at starting off where the returns have been in the global markets, chart 10. Apologies, it's a busy chart, but I just wanted to show a full bandwidth of the major global markets. There's European, North American, and Asian markets in there, including Australia. Now, obviously, we've talked about the Australian market is 10% price return plus another 3%, 13% year on total return from the Aussie markets running into February so far for the past 12 months. That's a good return, but Australia is only 16th position in the world. If you look at other markets, like you wouldn't think Germany is actually running the highest return at the moment at 28%, yet the German market is actually contracting economy. So obviously the market there is taking a contrarian view. It is deeply undervalued, Germany. So that's driven that market. So even above the S&P 500 from the US. So Germany is close to 30% return last 12 months. And the US market, which everyone has been talking about, is, about 26%. Then there were Spain and Italy. So European markets, despite this notion that Europe has been falling behind, they've actually, because they were sold off so much, they've actually had a good rally. And China's in between at about 12% return, and Australia's, as I said, just behind that. But India is about 6.5%. You might say, Max, should we be looking at China? How's that looking? So I wanted to show you just compare those two markets. Obviously, we've got a dedicated portfolio for India. So why are we not investing in China, either through a dedicated strategy or having overweight position in some of our other global portfolios? Well, I'm just looking at chart 12. Just broadly speaking, comparing the two markets just on valuations alone, Vijay, the Chinese shares are currently trading at 16 times, and they were trading at 13, 12 times not too long ago, and dividend yield of about 2.7%. India is trading at 18 times with a dividend yield of 1.5%. And you look at it and you go, oh, that India looks expensive. Well, no, it's not expensive because. Well, first of all, the nature of the Chinese stocks, as you can see, the Chinese stocks a lot of them are state-owned. There's and state-designed capital outlays and state-controlled. So what that effectively means is capital does not get naturally allocated to the place of greatest return in the next 2 years, 5 years, 10 years. It has, a whole host of other mandates. And a lot of the stocks listed on the Shanghai Composite Index are state-owned. So that's one issue. And obviously, you can see the Shanghai Composite Index, therefore, has gone sideways for the past 20 years for that part of that reason. Whereas the Indian stock exchange, this is relatively speaking more liberal. In fact, I was looking at an article from Financial Times. The Indian IPOs this year are going to be a record number, and in terms of billion plus revenues. They had a big IPO last year as well, and it is being supported not from necessarily from financial deposits from the global managers. It's actually the Indian average account holder is actually buying and participating in the Indian growth story. And over and above that, and we'll talk about it other calls as well when we do deep dives in India. Anyone who's been to India recently will say that there's been a lot of infrastructure development going on in India. A lot of projects in terms of roads and bridges and that type of thing. That has been a big bugbear for India in terms of transport and logistics. And more geopolitically, you can see India's vying to become an industrial power to basically export, the more modern consumer electronics and that type of thing. So, sorry, Vijay, did you want to add something to that? Or?
No, no, absolutely. I think overall the momentum is there on the Indian side. So I think there is you are absolutely right. There is a good possibilities onto the market and rallying of the markets.
So that's why I remain dedicated. And if just looking at chart 13, the returns speak for themselves, and Indian long-term returns are near on 10%, and the Chinese obviously 2%. So, that kind of speaks for itself. We remain very committed to Indian stocks on the long run, and it is the fastest growing economy in the world in any case for all the range of reasons.
Max, fantastic. Thank you very much for that. Now, before we ending up, if you can give a quick note on the investor desk portfolios, which you are running as well with us. So if you can just a little bit stories on all the the chart number 16 or all the funds, or what do you feel about those funds would be a good insight.
Yes, I just wanted to thank you, Vijay. Just looking at chart 14 first, with the performance of our India High Growth Fund. It has our selection of investments in there. You can see that has been, outperforming the even the broader NDIA ETF index. And last year our portfolio did 12%, and that broad Indian market did 8%, and longer term returns are
that's what I saw. That was very good.
Yeah, it just goes to show, Vijay, that and it's not just India, it's everywhere else as well. That if you do deep dive research and allocate capital in the right way, the alpha generation possibility is quite significant in these times of heightened change. If you can call the change correctly, then there are huge returns, and index returns will be left behind. A lot of people talk about the passive returns over the last 30 years. They did well, but that was a global regime that was very low volatility. Now we're going into a period of very high volatility, and we can talk about it at length, which would generate vastly different returns. So moving on to a 16th chart, as you can see, our more equities focused portfolios from ESG Sustainable Balance Fund all the way down to Australian Core. I would just like to highlight to you, our notional in our head is kind of, longer term returns between 8 to 12%. And, that's what growth gives you in terms of risk premium. And all of these are generating, ESG hasn't been hot at all. If anything, ESG has been in the negative. Yet our ESG Sustainable Fund is generating positive returns all along, all spectrum, above our expectation at 10.5%. Income maximized at 13.5%, almost 14%. India, as you can see, really doing well. Australian Core is doing well as well. Our conservative portfolios, again doing well. It's 10% last year, and cash, which is very stable kind of bank term deposit like investments, 3.5%. And we prioritize stability above anything else there. So yeah, I think in the broad, we're beating our own expectations right across our portfolios is the main theme, Vijay.
Yep. Now, Max, look, Max, thank you very much, and thank you all for joining us. I think it was a really good session, and I heartily appreciate the portfolios which you had in. I think the investor team has done a good job overall. Max, your call, and thank you very much from my side.